Technical analysis is one of the most important tools in a Forex trader's arsenal. It helps you understand price movements, spot patterns, and make better trading decisions. While it might sound complicated at first, it's actually straightforward when broken down into simple concepts. In this video, we'll walk you through the basics of technical analysis, covering candlestick charts, trends, support and resistance, supply and demand zones, and even volume. Let's get started. Candlestick charts are the foundation of technical analysis. Instead of just showing price as a single line, they provide more detailed information about what happens in a specific time period, whether it's a minute, an hour, or a day. Each candlestick has a body and wicks or shadows. The body shows the difference between the opening and closing prices for that time period. If the closing price is higher than the opening price, the candle is usually green or white, bullish. If the closing price is lower, it's red or black, bearish. The wicks above and below the body show the highest and lowest prices during that time. For example, a long wick on top of a red candle means the price went up during the time period but came back down before closing. A green candle with no wicks means the price consistently went up and closed at its highest point. Learning to read these candles is like learning the language of the market. They tell you stories about who's in control, buyers or sellers, and help you spot opportunities. If you've heard the phrase, "the trend is your friend," it's because trends are one of the simplest yet most effective ways to trade. A trend is just the general direction the market is moving, up, down, or sideways. In an uptrend, prices make higher highs and higher lows. This shows that buyers are in control. In a downtrend, prices make lower highs and lower lows, signaling seller dominance. A sideways trend happens when prices move within a range, showing no clear direction. Spotting trends is simple when you know what to look for. Draw a trend line connecting the lows in an uptrend or the highs in a downtrend. These lines act like a guide, showing you where the price is likely to go next. When the price touches a trend line and bounces off, it's often a signal to trade in the direction of the trend. Support and resistance levels are like invisible barriers in the market. Support is a price level where the market tends to stop falling and might start rising. Resistance is the opposite, a level where the market struggles to go higher. Think of it this way: support is like a floor, and resistance is like a ceiling. For example, if the euro-dollar pair keeps bouncing back every time it hits 1.100, that's a support level. If it struggles to go above 1.120, that's a resistance level. When the price breaks through support or resistance, it can signal a strong move. For instance, if the price breaks above resistance, it might mean buyers are taking over, and the price could rise further. Marking these levels on your chart helps you decide where to enter or exit trades. While support and resistance are like lines on the chart, supply and demand zones are more like areas. These zones show where there's a lot of buying or selling pressure in the market. A supply zone is an area where sellers dominate and prices tend to fall. You'll often find supply zones near resistance levels. A demand zone is where buyers step in, pushing prices higher, and these zones usually align with support levels. For example, if the price keeps dropping but then bounces back up every time it reaches a certain range, that range is likely a demand zone. Similarly, if the price struggles to go above a certain range and keeps falling back, that's a supply zone. Trading around these zones gives you an edge because you're working with areas where big players are likely making their moves. Volume isn't just for stocks, it's a valuable tool in Forex too. Volume shows how much trading activity is happening at any given time. While Forex doesn't have a central exchange like the stock market, most trading platforms offer tick volume, which measures the number of price changes during a time period. High volume often signals strong market interest and confirmed trends or breakouts. For example, if the price breaks above a resistance level with high volume, it's more likely to continue rising. On the other hand, low volume might mean the breakout is weak, and the price could fall back. Using volume alongside candlestick patterns and other tools gives you more confidence in your trades. For example, if you see a strong green candle at a demand zone with high volume, it's a good sign that buyers are stepping in. Technical analysis might seem like a lot at first, but it's all about combining simple tools to build a complete picture of the market. Start with candlestick charts to understand price movement, then look for trends, support and resistance levels, and supply and demand zones. Add volume to confirm your analysis and give you the confidence to take trades. The more you practice, the better you'll get at spotting opportunities and avoiding common mistakes. Technical analysis isn't just about predicting the market. It's about reacting to what the market is showing you in real time. If you found this video helpful, hit the like button, subscribe, and let us know in the comments what topics you'd like us to cover next. Thanks for watching, and we'll see you in the next lesson.